Hey guys, John Paulamy here, Actionable Intelligence. And today in the ongoing interview series, we have a special guest, Peter Sainsbury from the UK. He is a person that I follow on Twitter, and he has a website that I follow called Materials Risk. And he's written several books about commodities and resources. I find his writing to be very, very prescient and very useful. He sends out a weekly email that you can subscribe to, and I'm sure he'll let us know at the end how you can do that. But with all of the discussion around an interest in commodities and resources as they seem to be doing well recently, I thought it would be a good idea to have Peter on and have him share his information. So Peter, welcome to the show. And if you wouldn't mind, can you just give us a little background or what you do and how you got to where you are here and what you're currently doing?
Yeah, great to be here, John. Thanks for the invite. I'm my sort of day job is an economist, but I'm very much an active investor in commodity markets, and have been over the last about 20 years. As you mentioned, I've also written a number of books, particularly focused on commodity markets, and what I've really tried to do is, through my own journey through these markets, is to try and help other investors as well, educate them about commodity markets in particular, but really how commodities fit in with the sort of broader sort of macroeconomic trends.
All right, awesome. So I've seen a couple reports come out from Goldman Sachs and Morgan Stanley. I actually did a Google search or trends on the word supercycle. This is now entering the lexicon or the terminology in the investment markets. I noticed that you did write an article in general about supercycles, what defines them. So the thing that I'm concerned about, or I'm curious about what your view is, obviously I was around for the previous so-called supercycle, which was basically, over a decade ago. We saw record highs in many resources and commodities, specifically because of China and what was going on there, their build out. Do you have a view that we are entering another supercycle, cyclical or secular, or is this more these recent runs in some of these commodities with copper making 8 and 9 year highs, oil now moving above $60 Brent, various other commodities, ag commodities going nuts? Is this, to your mind, the beginning of a cycle or super cycle, or is this just the result of an inflationary impulse from monetary, the amount of tsunami of monetary infusions we've seen around the world?
Mm-hmm. Yeah, I think it's both of those things to an extent. But I mean, to row back, I think you mentioned the previous commodity cycle, super cycle, and that kind of really started in the late 1990s, early 2000s, and then ran up into oil peaking in about 2008, and other metals around 2011. But what you tend to get through history is this almost repeated cycle of 10 to 15 years up cycle, and then a similar period of of weaker or lower prices as that kind of excess capacity is gradually worked out of the system. So applying that kind of that framework in terms of timing, at least, we're very much I think at the stage where we're starting to come out of that trough in the cycle. So I think there's a number of factors that are driving that. I think on the demand side going forward, you've got the social factors that are going to drive spending by governments going forward. So since the financial crisis has been very much a focus on financial stability. But I think going forward, it's going to be very much about social stability. Governments recognise they can't go back on, back to an austerity environment. So there's going to be a lot more spending on, correcting, inequalities within society. Whether that's through, MMT or some other, mechanism by which, that money can get into the real economy. And then there's other factors like things like the environment. So, the past year, the COVID crisis, that has focused attention on some of the sort of wider environmental problems. So you're going to get a lot more, or what we've seen is a lot more investment in a lot more focus from investors on ESG, and that that's going to drive demand for copper, nickel and other metals as well as the kind of, sort of minor metals like things like cobalt as well. And then you've got the the kind of the change in supply chains. So from a period of globalization to one where things are more bifurcated. You've got the US world and the China world, and that's naturally going to create. It's going to take a while to become efficient. So over time, in the short term at least, you're going to get lots of bottlenecks, higher prices, and you can kind of see that with things like shipping rates at the moment. So if you're trying to ship something from Shanghai to Western Europe, people are paying 3 or 4 times what they were about a year ago. So all these kind of sort of inflationary things are starting to creep in that suggest we're at the very early innings of a super cycle. But then I would add there's things like you mentioned in terms of central bank stimulus. That's going to be a real tailwind for commodity prices, particularly things like gold and silver going forward. But then I think the other point to mention, and it goes back to the commodity super cycle, is on the supply side. There's just been this lack of investment, not just oil, but other commodities as well. And as that demand starts to increase, what we'll find is that that there won't be sufficient supply to meet that demand, which will help support prices.
Yeah, I think I'm reminded, one of my favorite mining entrepreneurs is Robert Friedland. He's kind of a character, and he was interviewed recently, well, it was a couple of years ago at the African Mining Indaba. And I think somebody asked him a question about copper. Obviously, he's self-interested. He's developing one of the largest copper mines in the DRC. But he said that they asked him where he thought the copper price was going to go. And he said, well, you're going to need a telescope to see how high it goes. But I mean, that kind of makes the point, though, doesn't it? Because I think one of the mistakes I made when I'm attracted to the resource and commodity markets, I have been just since I was a little kid digging in the dirt. Something about it just appealed to me. So I've always been had an affinity for it. But now that I'm older and I've lost a lot of money earlier in my career, because one of the things I didn't understand about resources, and you touched on it a bit during your opening remarks, is the cyclicality that's inherent in commodities and resources markets, or any type of resource. These things, Doug Casey, another guy that I like listening to, he used the term that, when you're investing in these markets, specifically the companies that are involved in mining, which is a method to take advantage of, these things are what he calls burning matches. I mean, these are not like, you don't buy these and hold them for like widows and orphans, because the inherent cyclicality. And I think having an understanding of the cyclicality and what drives cyclicality, you have to understand that because just because I think of some of the investment timelines and really mining's a really crappy business. It's not a really good high margin business, except for these short periods of time like we seem to be entering now, when prices go up because of the previous lack of investment. So if you could touch on that, the cyclicality, or any kind of work you've done on that, or how you look at that, or what your view is on that.
Yeah, no, I think that's a great point, because I mean, if you look at literally the long run price of commodities, over 50, 100 years, oil slightly different in that, that because of the nature of the market, that has increased in price over time. But most other commodities have actually stayed pretty much the same over a long period of time in real terms. So you're right, they're not a buy and hold forever investment. So the key is to be able to understand where you are in the cycle at all times. Trying to get near the bottom of the cycle. But then it very much depends on your being clear on your time frame. So I mentioned the commodity super cycle. So if looking back, you could have bought back in 2000 and sold out 2007, 2008. That was a great buy and hold strategy over those several years. But even within that period, there was periods where those markets moved in cycles. And kind of looking back, you tend to get this 4 or 5 year cycle within these larger super cycles. And part of that's related to things like just the business cycle. But other factors relate to the weather, crop cycles and things like that. So I think for any investor, it's being clear about what time frame they're investing in, being clear where they are in the cycle, and then understanding if it's a short-term play they're making, is recognize when that short-term cycle is starting to turn.
So I think, I read another article and you kind of pointed out, which I thought was important too on your site, like there's a difference in the cyclicality or timing, or the length, I should say, of a cycle, as you would talk about maybe like copper or something like that, vis-a-vis like agricultural commodities, because of the crop cycles yearly. Now you could have, I think, inside of that, which is something I've been talking about, and I want to get your view on that also. But you could have, example I would think is like the Chinese. Now they had some poor crops in there because of the rains they had there. Really weren't publicized. The decimation of their hog population, they're rebuilding. So they have this tremendous amount of import of soybean meal and corn and stuff like that. That can affect something. But then also, we've had tremendous, in my view, facts are great growing conditions for like the last 5 or 6 years. We've had great carryovers. And so I think if you really want to be involved in this, I guess, you really got to, it's not something you just, do it on a fly and just fly or just say, I'm going to buy this. I mean, understanding each individual market, they do have their intricacies, and like in agricultural markets, noted that they, you could have a smaller cycle instead of a larger cycle just based on weather or some kind of one-off demand.
Yeah, that's right. And I think another thing people misunderstand or don't appreciate is that the interaction between different commodities. So energy, oil in particular, is a big driver of other commodities, and in turn they also drive some of the margins that miners and other commodity producers can make as well. So you can't just focus on one in isolation. You have to kind of see how that puzzle evolves over time, and being able to anticipate how those different cycles move around.
You wrote a book, like I said, I haven't read them, but I just did want to ask a couple questions based on the titles and the synopsis that I read. Commodities, 50 things you really need to know. Obviously, we're not going to give up all the good stuff here, but what are some of the issues or ideas or facts that people misunderstand about the commodity markets? Like, what are some of the major themes that they really need to know going into this?
Yeah, I mean, one that was kind of like was perhaps dear to me, but kind of hit me in the wallet was the importance of geopolitics. So I did an interview maybe about a year ago now, where it was I kind of described my worst investment, and it was a gold miner based in in Asia, in a particular country, which was a very low cost producer, and I was looking at it as being a good a low cost bet on the gold price. If it went the wrong way, it wouldn't be too bad. But what I didn't really count on, or didn't really, to be honest, hadn't put enough research into the specific factors in that country. I got stung by the change in the policy in that particular country. So it's things like that. Geopolitics is a very important factor. Not just globally, but clearly at an individual commodity level as well. And then I think, although it's not something that you can always time, it's being aware of what the positioning is in the commodity futures markets are, and the dollar especially. So if you look at the actions of in particular hedge funds, you can see at certain periods of time whether they are kind of net long or net short. If that position's at an extreme level, sometimes even if the fundamentals look promising, say for in terms of prices going up, if that positioning is to the extreme, then it's a sign that perhaps you should be a little bit cautious about entering the market at that particular time. So it's factors like that which short-term traders would be more aware of, but longer-term investors, it can certainly help them with their positioning. And then I guess another thing is just about, and I think this touches on my second book actually, is to be aware of the what's actually put out in the public domain by investment banks. At the very start, you mentioned about the commodity supercycle becoming a more common title on from Bloomberg to whatever else, and sometimes you've got to be careful that the investment pieces and research and forecasts that are put out in the public domain, sometimes that is they're trying to sell investment into the companies that they're trying to fund, not necessarily in the best interests of you as a commodity investor.
Yeah, I mean, I'm not shy in giving my opinion. I mean, these people always are talking their book. That's how I approach anything that they say. So, but however, as we both know, that doesn't necessarily mean they're wrong. I mean, that's really a thing we could touch on also is sentiment. One of the things I like to use is sentiment indicators, and that's really important to me, is because that's why I try to use public sentiment and the media, what I see in the media being put out there, or what people are putting out, investment banks. Obviously, that makes sense, and because we're in such a highly liquid as far as there's so much money has been created, and so much central banks have basically turned everyone into a speculator now, as opposed to an investor class, and rampant speculation. So, I mean, I noticed on one of your articles, and it's a theme that I picked up on. This is why I think a lot of your thoughts are pretty good when I read you showed a cover of Barron's recently. And, I'm a big proponent of the magazine Indicator. I like to look what, The Economist is famous for picking tops and bottoms with their covers. Yeah. So I remember one of the best investments I ever made was in a company in Kazakhstan. It was an oil company, and it was based on their article. They had a cover, I think it was in 97 or 98, the end of oil. Whenever oil was like $10 a barrel or something, it was the end of oil, okay. Yeah. And then, of course, we went on this tremendous run, like you ended up at $150 a barrel 8 years later. But anyways, you talked a little bit about sentiment, but, what other tools do you use to, I know commitment of traders, you mentioned watching that, but other sentiment indicators, because like we just said, yeah, they could be talking their book, but how what's the right term? How much money is really in the commodity market? Seems like you said, we were on the early innings, but what would be some sentiment indicators you'd be looking for to say, hey, this is time, because you're never going to catch the exact high. So
No,
how do you start looking at, like, okay, this is getting to an area where it's near the top or near the end?
yeah, I think yeah. So I think things like magazine covers tend to be kind of sort of lagging indicators because just because of the time it takes.
Mm-hmm.
I think you mentioned The Economist. They they prepare and write these articles weeks or months in advance, so they're having to judge a cycle, a trend, and and then even if it's turned by the time they publish, they still go ahead and publish it. But you can see things in the sort of general media. If there's articles like reports of so and so making a killing on a certain market, and I think what worries me at the moment from markets in general is there's so much focus on retail participation in the markets. You mentioned about markets being turned into a just speculation, a casino in a way, but you tend to get that real run up in speculative activity at the peak of the market from financial markets in general, not necessarily commodities at the moment. Excuse me. So it's things like that I look for at the top of the market, and then just to touch on things at the bottom of the market. It's when if a market is completely hated, and people just won't want to touch it with a barge pole. They just it's uninvestable, and I think for many investors, certainly institutional investors, that's where oil is at the moment. Maybe some other fossil fuels as well, because we've seen the pressure from ESG funds to divest from any association with fossil fuels, and I think that's created an opportunity for investors who are able and willing to look at it as a favourable bet. What you tend to get is the market will always clear, even if there is the demand from the institutions have gone out. That means others that can take a position can look in that market. So thinking about oil companies in particular, especially ones that are actually still oil companies, not the ones that have recently tried to diversify to renewables. You start to see the yields go up, to try and attract investors, and that starts to look like quite an interesting kind of asymmetric proposition.
I thought it was interesting that you said that, because I mean, that's exactly right. And I think one of the things that people that want to, I mean, as I mentioned, these are typically not that good of businesses over the average, if you average them out for 20 years. But then you get into these time frames like we're in now, where some factors come together cyclically and politically and some of these other things. And I am really excited because, we had a change in administration here. The first thing that the administration did was ban fracking on federal land, banned any new leases. And does that single event mean it's going to create higher oil price? No, but you start combining these, piling the straw on top of the camel, this here, a little bit there. And, this, I mean, I almost view it as being suicidal. I don't know what's gotten into people's heads. Energy underpins everything that we do. It allows for the civilization we enjoy. Do I believe we should be good stewards of the environment? Yes. But just to say that we're going to get off, I don't understand, Peter, what does zero carbon mean? I don't know what that means. I mean, I am in the renewable, I call them rebuildables. Somebody else coined them that. renewables market is actually the rebuildables, because entropy means that the panels and windmills have to be replaced. They wear out. They're machines. So I don't understand. I mean, you're an economist, so that means you have an analytical mind. You make models. I think that we'll have an energy transition, but I can't find an energy transition throughout mankind's history for the last 10,000 years of civilization where they went from a dense form of energy to a less dense energy form in an energy transition. I mean, we moved from roving bands of hunter-gatherers burning animal dung and wood, then into burning, wood, then to coal, then to petroleum age, then the nuclear age. And the thing that I find common in those is that the energy sources got more and more dense. You had more energy in a smaller, and now we're talking about, I mean, I know you've probably been to the Netherlands. I mean, you could still go to see windmills from the 14th and 15th century. They're museums now. They don't actually use them to grind grain or pump water for their canals because the steam engine was invented by James Watt. So,
Yeah.
I mean, this is, and then if you look at the third world, developing world, emerging world, you've got however you want to characterize it, 1 billion people, maybe more, that have never flipped a light switch. Their first light switch is not, or the first light in their house is not going to be powered more than likely by a windmill. It's probably going to be a coal or natural gas fired power plant. So, and I start looking at the numbers and put these things into spreadsheets. I believe there will be an energy transition. There's going to be this effort to decarbonize in the West, but I look at that's 800 million people in the West, and I'm looking at the other 7 billion people, and I'm seeing a lot of lip service being paid by China and India and these places that if anybody's actually been to India, I mean, it's not, they have a lot of problems there, and it's going to be very energy intensive to fix those problems. So I think some of these things are tremendous tailwinds that people really need to realize. And let me ask you this. I mean, I don't want you to delve into the political. I don't want you to, say whatever you want, but is it really possible to transition? I mean, there'll be a transition, but it's not going to be in the next 2 or 3 years, because any energy that I've seen has taken decades. I mean, and I think that the tailwind, ministers like in India have said, hey, we're going to use the resource. We have a right to develop also, and not just to constrain our population. So any views on that or ideas? I don't want to drag you into a political conversation, but it's just, it has to be talked about because it matters. Royal Dutch Shell, Total, Equinor, they're all going to build renewables. Well, that's not their core competency. Their core competency is oil and gas exploration. So, I mean, any comments?
Yeah. I mean, there's 3 or 4 things there. I mean, you mentioned about energy transitions, and there's I think the book by, I think his name's Vaclav.
Yeah, Vaclav Smil. Yep.
Yeah, and he describes energy transitions over time, and it's always been it's always been a kind of market orientated transition. It's never been a kind of government mandated transition. It's always been to something that's more more efficient, more better for for the consumer of that, whether it's transportation or whatever other application. And so I do think that we're in a very different transition here, where it's going to be government mandated. It's going to be policy that's going to direct that transition. So as investors, yes, it might pay to pay attention to what people what governments are saying, despite we might not necessarily agree with what they're saying. And then you touched on India, and I think and this kind of segues back to the the kind of commodity supercycle proposition, in that they've got potential to be a very big driver of not just energy demand but commodity demand over the next 10-20 years. You might have seen the protests over the last couple of weeks from farmers at various parts of the country, and they're protesting against what they might see as kind of more market-based reforms of the agricultural system. But it's really kind of almost like a sort of growing pain in the country, in that they are transitioning very slowly from an agricultural society to a much more one focused on services, manufacturing, and essentially urbanizing the country. So that's going to be a massive tailwind for energy and commodity demand. If you think of how they're going to build up that grid of power and telecommunications and everything else, and then just in terms of their energy use, it's not just India; it's other countries in Southeast Asia as well, and places like Africa as well. That they've as they've developed, they've focused on coal as their energy source, and that's kind of, that makes a lot of sense, and from their country's perspective, in that they might have those resources domestically. Coal's a commodity that can be sort of stored and moved about relatively easily, but that in the transition in the West, we're clearly trying to move away from coal, or we have moved away from coal very fast and towards gas and then renewables. But many of these countries like India and others, they might only be 10, 20 years kind of halfway through the life cycle of a coal generation plant. So it's going to, if they were going to change over to gas or some other renewable, it's going to cost them so much more money than what we're going to experience in in Europe and North America. So I don't think we necessarily appreciate that, and we just see it from our own domestic perspective. And then your final point about certain companies through pressure from shareholders have moved towards renewables, but I as you say, some of them aren't necessarily that experienced in that area, and I think what their share prices have suffered because they're so late in the game. They've had to pay top dollar to be able to develop those assets, whereas other more renewable focused companies that have been in this game for 10, 20 years, they're ahead of these big multinational oil companies.
Yes, indeed. And I didn't want to, I'm not trying to get you to, take a position. I have the position, I was looking at this, because you're exactly right. It doesn't really matter what I think, makes sense, because I'm not king of the world. It's there's a political agenda. It's going to be carried out. These are democratic societies, so that means, for the most part, the people are on board with this. And so I kind of approach it from the perspective of I've been calling it recently, heads I win, tails I win more, because just to your point, with the sunk costs, like you mentioned, with a coal plant that can last for 30 or 40 years, you're not going to demo the thing if you just built it to put up windmills. It's not going to happen. But then again, I also realized that, a lot of these schemes, maybe in my mind, having been in this business, maybe don't make market sense relative to other competing energy sources, but the decision has been taken at a political level that that's going to happen anyway. So there's no sense swimming upstream or trying to sail into the wind, turn the ship around and catch the tailwind. So, that's why I'm a big advocate now of okay, electric vehicles, it's not just Tesla. I mean, Volkswagen's committed $40 billion, all the major manufacturers, we go down the list. So what does that mean? That's why I like listening to people like Robert Friedland. The guy's an entrepreneur. And if you listen to him, I listened to a recent interview that he had with Simon Moores or somebody, the guy that does battery metals. I mean, I don't really think he has a position. If you really pinned him down and waterboarded him, well, maybe he does believe it. Maybe he has a position. Everybody has their own but he's mines commodities. That's what the guy does. So it's okay, well, if you're going to have tens of millions of electric vehicles, then you need nickel, lithium, cobalt, and some of these things, that's the tails, heads I win, tails I win more, because the petroleum age is going to go into a sunset, but it's not going to be in the next year or two. And I think with a cyclicality that represents in the underinvestment, that's what creates your opportunity and can, it doesn't really matter what happens as long as you understand what's really happening. You can take advantage of that and profit.
Yeah, that's right. I mean, climate concerns, ESG investing has, created an opportunity in that, it's reduced that investment into, conventional, oil and other sources. But yeah, at the same time, it's increased demand for things like copper and nickel and other metals. I think another thing I'd sort of perhaps touch on that I think Robert Friedland has discussed recently was about trying to find a way of differentiating between the source of particular commodities, so that you might have like a different variations of brown or green or other color for different metals, based on where they've been mined and how they've been mined, and then that could be then factored into some kind of premium or discount. So there's I think there's potential for it to even the whole sort of pricing mechanism for metals to evolve over time.
I'm glad that you mentioned that, because I'm actually looking at a company that he is a angel investor in. It's called Abix Technologies. I believe they're based in Singapore. They're getting ready to roll out their first product, which is an LNG product. I don't know I've been just looked at it recently, but that's exactly what they were intending on doing, is having this, with the LNG market being so bifurcated because of transportation. I mean, you could have $20 MMBTU in Japan, but $2.75 in Texas. And this, they're creating this new exchange is going to have different contracts for, just to your point, if something's more ESG compliant versus some warlord in Liberia mining something, there's going to be that differentiation. Then people can obviously market based deal with that, because there is a big push for that. So that's interesting, and especially with blockchain technology, I think is involved in this too. So yes, that's very very important. I mean, I guess what one of the things that I wanted to also talk about was how do you express your investments or themes? I mean, do you do futures contracts, options? Do you just buy shares in companies that are mining or producing these commodities? I mean, how do you express your investment ideas via actual investments?
Yeah. I mean, mainly through investment in commodity producers. Certainly on a sort of longer term. I talked about those cycles.
Yep.
So it could be a couple of years or several years in case of a long-term cycle. But then for very short-term positions, it tends to be either an individual commodity futures market or an ETF, for example.
Okay. All right. Do you want to, I mean, we're getting to the end of our time. I just wanted to give you the opportunity to talk about some of the work you do. And I mean, I don't think you have enough people following you. I mean, I've told people, I mean, they need to subscribe. You put all your information out for free. It's not like you have a paid service or anything, but you do have a couple books you've put out, which I intend on reading, and also your website. And I believe you're on Twitter also, but I encourage people, I think you have a mailing list you can get on to, and you come out with occasional emails. Then you have this other thing that you come out with that kind of, I like it because it has like, well, you can describe it, a bunch of different articles or reports that you aggregate and put out. If you could talk about some of your work and how people can follow you, that'd be great.
Yeah, the best place for people to find me on Twitter is at Peter Sainsbury 7. And there you'll see a link to my website, which is materials-risk.com. And as you say, I tend to post an article maybe a couple of times a week, and every fortnight I do a kind of like a sort of research roundup that kind of the best research I found freely available on the internet, whether it's macroeconomics or commodities or whatever else, and then also links to some of the sort of best books or podcasts that I've listened to over that time, so you'll see the links to my books on the website, a couple about commodities, one about kind of understanding sort of media narratives more in better detail, and how that can be used for investment, and then the final one about betting on Formula One. So a very different book.
Yeah, we talked offline about that. I got to get that just to read it now, because it's so far away from but I guess it does kind of tie back, because we talked offline about that. So that's interesting. I'm going to read that also. That seemed, I just have to, because it seems so off the wall. Now I got to read it. So it's good. Well, Peter, definitely appreciate your time today. And like I said, I wanted to introduce my readership and viewership to your work, because I think it's outstanding. I don't want to embarrass you or anything, but it's really, I mean, just about every article I've read of yours or every email I've gotten has been useful to me. I mean, and further on research, your recent one about India, for example, was outstanding, a theme that I was already on. And so I look forward to seeing more of your work, and I encourage everybody that's watching this to sign up for your emails and get on that email list. So definitely appreciate your time today, and thanks a lot.
Yeah, thanks, John.
All right.